Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and today I want to talk to you about the Perth market and why I believe it hasn't peaked. And I'm also going to touch on the 18.6-year property cycle, which was brought to us by a guy called Fred Harrison. Good old Fred. Thanks, mate. So what I'm going to take you through today, basically I'm getting a lot of people saying Perth's at its peak, it can't go any further, blah, blah, blah. And then I've heard some people talking about the 18.6-year property cycle as well, which, has merits, but I want to talk to you about why I believe Perth always bucks the trend when it comes to market cycles, and that's because historically in nature it has been counter-cyclical to Melbourne and Sydney. And when we talk about the market in general, in Australia we talk about the Sydney and Melbourne market, and we always forget about poor old little Perth over here in the west. So I'll talk about where Perth is sitting on that clock. I'll talk about the latest stats from REWA, and I'll also talk about how long I think is left in this market in Perth. So if you're sitting on the sidelines either waiting for the crash, or if you're sitting on the sidelines thinking, I'm going to wait till the steam comes out of Perth, then this episode might help change your mind. And don't forget, this is just my perspective on it. It's not rooted in concrete that this is definitely going to happen, but this is just my observation sitting on from one side looking in, shall we say. So let's start with the 18.6-year property cycle. It isn't just theory, it's grounded in over 200 years of historical land price data, or data, depending on where you're from. I'm a data guy. It's been observed in markets in the US, the UK, and more here in Australia. And the idea was popularised by a guy called Fred Harrison, a British economist and historian who discovered this repeating pattern in the 90s. And the pattern is generally recover, mid-cycle dip, boom, peak, crash, reset. So recovery, mid-cycle dip, boom, peak, crash, reset. So even just talking about that now, where do we think Perth is? Recovery, mid-cycle dip, boom, peak, crash, or reset? And we only need to really look back at what's happened in Perth over the last, let's say, 12, 13 years. We had the crash, we've reset, we've recovered. Basically, we are back to prices in 2015-ish, just before the last crash. So we could be at the mid-cycle dip right before the next boom. And I know for a fact there'll be people on the East Coast now saying, Neil, it's too unaffordable, Perth, it's reached its peak, no one can afford to buy property. Well, sorry, Sydney, I've got some interesting statistics for you guys as well, because back in 2010 Perth and Sydney were a very similar price point. Sydney has taken off, agreed, but it is the most unaffordable state in the country, yet the market's still moving. How is that possible? So firstly, who is Fred Harrison? He is an economic historian who's been analysing land cycles since 1970. And he's made some spot on predictions. First and foremost, in 1997, Fred predicted the 2008 global financial crisis. That's 10 years before it actually happened. That is like predicting the lottery numbers and actually getting them. He actually said the next property crash will come in 2007 and 2008, and he was right. And he also called the 1990 UK housing crash back in the early 80s. And he's not just guessing this, it's cycle-based forecasting that's been grounded in history. So the cycle broken down is every 18.6 years, the cycle typically includes 7 years of recovery. So the market rebounds post-crash, lending starts to loosen, confidence returns. The market rebounds post-crash. Sound like Perth? A short 1 to 2 year mid-cycle dip triggered by rate changes, regulation or black swan events, e.g. COVID in 2020. Now, we didn't really get a mid-cycle dip after COVID, did we? Because the market went absolutely bonkers pre-COVID. And in mid-COVID, people were locked up in the houses, still buying houses. Incredible. After the 1 to 2 year mid-cycle dip, we get a 7-year boom, which prices surge, speculation increases, FOMO kicks in, credit is flowing. So I believe, and the RBA cash rate is coming down, credit will start to loosen back up again. And then after that, we have the crash or major correction. So over-leveraged or economic tightening causes a pullback, then the cycle resets. So let's just run through them again. 7 years of recovery, followed by a short 1 to 2 year mid-cycle dip. Then we get a 7-year boom, and then we get a crash or major correction. So where are we now in Australia? So Sydney and Melbourne experienced their mid-cycle slowdown in 2018, 2019, boomed in 2020 to 2022, and now they sit at or near their peak. Melbourne's actually come right off the boil, right? Sydney, there's a little bit of movement there, right? But when I get to the affordability stats that I'm going to give you soon, you'll see that these numbers that are floating around are literally fringe suburb stuff. On the other hand, missed out on the East Coast boom. Why? Because we always act counter-cyclical, right? So it was still in recovery through 2020 and 2021, which means it's now just entering its true boom phase. So if history holds, Perth could easily have another 3 to 5 strong years ahead, which will be until when the next major correction may occur. That's in Perth, right? But the way the property clock works is Sydney and Melbourne should be slowing down in 2026. And like I say, Perth always acts counter-cyclical to them, which means we should see a big run ahead. So where's Perth on the clock right now? Perth is around year 10 or 11, which is early boom territory. And everyone's saying Perth has peaked, but let's think about it again. Supply and demand, I really cannot understand how the fundamentals would shift and how there'd be a drop in property prices when there's too much demand and not enough supply. Yes, we've had growth. Yes, rents are rising, but it doesn't mean it's over. Like, I was listening to another podcast the other day, and there was a guy that was a real estate agent in Sydney. Now he lives in Perth. And for years in Sydney, everyone was saying, I'm selling now because it's at its peak. I'm selling now because it's at its peak. And they sold out, and it just kept going and kept going and kept going and kept going. But now their mindset's changed, where they're like, everybody who bought in 2012, 2013 in Sydney all thinks they're a guru property investor because they bought a property and did nothing apart from sat back and held. And to be honest, my grandmother could throw a dart of a map of Sydney with a blindfold on, and she would have made money in that time frame as well. So it doesn't mean they're a guru, and it doesn't mean they know what's going on. It just means they bought property and hold, which is a good strategy. Right? Buy, hold, and die. PhD. So the data from REWA at the minute says that Perth values rose at 0.3% in February. And so far, the annual growth in Perth is 14.3%, which is the highest in Australia. Houses are selling fast. The average days on market has dropped down to 13 days. They're selling faster. The median rent is $675 per week, which is up 8% year on year. And rental yields are sitting at 4.3% on average, which is well above Sydney's 3.1%. So as it looks, you can just see right there, right? The market's moving, it's not slowing down. So be careful what you read in the newspaper and make sure you're backing yourself with actual data and statistics. So let's go through them again. Perth rose 0.3% in February. Annual growth of 14.3% is the highest in Australia. Houses are selling fast, 13 days, average days on market. Median rent, $675 a week, up 8% year on year. And rental yields are 4.3% on average. Yes, they've come down. So what? It's still, I was going to say good there, but to be honest, I wouldn't be investing at 4.3% rental yield, 10% or nothing for us. So why hasn't Perth peaked? Let's look at the 4 key reasons. Affordability. Perth remains one of the most affordable capital cities in Australia, behind Darwin, I think. But right now, Perth, median house price, $760,000. Average income, $112,000 per year. Price to income ratio. This is how affordability is measured. Price to income ratio, 6.8 times. So that means the income to price can be multiplied 6.8 times. Melbourne, median house price, $930K. Average income, $101,000 per annum. Price to income ratio, 9.2x. Sydney, median house price over 1.4 mil, average income $2,000 a year, price to income ratio 13.7%. That is double Perth, right? But Perth ran out of steam. It's had a big run. It's getting unaffordable. Well, I'm sorry, guys, but Sydney's well and truly unaffordable, but it's still moved to the fact where price to income ratio is 13 times. Brisbane, median house price, $850, average income, 98 grand a year, price to income ratio, 8.7%. So, if anything, Brisbane's a little bit more unaffordable than us, but we're still the most unaffordable out of the big 4. So even after Perth's big run, it's still much more affordable. Now, to match the affordability levels of the other cities, Perth's median house price would need to jump to 1.03 million to match Melbourne's price to income ratio. But check this out. If we want to catch up to Sydney for our price to income ratio of X, it means our median house price in Perth would go to $1.5 million. So is it going to go to $1.5 million? Who knows? Has Perth got as much desirability as Sydney? Who knows? Look, the population's bigger there. A lot of people move to Sydney when they first come to the country, but a lot of them also move out as well when they realise how difficult it is to live there, how expensive it is to live there, how hard it is to find property there, how hard it is to get to work on a morning because the roads are gridlocked. So Perth, at the minute, everyone's looking at it because it's the lifestyle, the weather, the price point, the wages that you can earn are all much better than the rest of the country. Still says that right now there's 4,829 properties for sale. And they're using this old stat of a balanced market as 13,500. That's before the population increased by 150,000, 200,000 people. And it's also when we had less properties on the market. So if we increase that to $14,000 to $15,000 in line with the population that are here now, we just tipped over 3 million people in Western Australia. So that balanced market should have a higher number on it, I believe. However, we're still sticking with that number. So look, we're still well and truly underneath the balanced market in terms of properties for sale. And with building delays, migration and tight land supply, and the fact that migration people are still coming to this state, it's not going to fix itself overnight. This is why I believe we've still got 3 to 5 years of price increase, capital growth, because this is a long-term fix. The government are throwing billions at it. Investors are actually leaving the market now because they believe Perth is cooked, and they're going to Melbourne. And Melbourne's on its knees, don't get me wrong, it probably is the next market to move. And just so you know, the HMO Property Co is going to open up in Melbourne and start building rooming houses in Melbourne, and we're also going to move living rooms to Melbourne. So if you're interested in working with us in Melbourne, let us know. We're actually moving there in April. Troy and I have been over there a few times already, met with builders, met with building certifiers over there, and we've been looking at sites and areas that we want to work in ourselves. And to test the market, we're actually buying a block ourselves, so we're not going over there and blindly telling our clients to invest there. We're actually going to lead the market, and we're going to buy a block ourselves, which we've got a contract on one already. So in Perth, back over at the west, we've still got a tight rental market. Now they're saying, and we've touched on this previously, right? They're saying that the vacancy rate in Perth is 2.3% and a balanced market is 2.5 to 3.5%. But the median time to lease a property is 15 days, and we've still got just over 2,000 properties in Perth available for rent. So the vacancy rate, I think, is a bit of a fugazi, a bit of a smoke and mirrors sort of number or metric that you can track, because we've had between 1,800 and 2,200 properties available for rental in Perth for the last 2 or 3 years, and the vacancy rate's at 0.4% to 0.8%. And no additional properties are available for rent, but the vacancy rate's increased to 2.3%, which can only mean that properties have been removed from the market, so there's less properties available to rent, which means the vacancy rate is higher. I hope that makes sense. So although the investors are leaving the market, there's still local investors. I still speak to a lot of people that don't want to invest outside of Perth because they like to drive past, touch and feel and smell their property. And we speak to a lot of investors from the East Coast that don't want to invest in Perth because they want to invest in their hometowns of Melbourne or Sydney or Brisbane, so they can drive past and touch, feel and smell their property. For me, I don't particularly care. It's just a numbers game. If I build this property, what's it going to cost me? More importantly, what's it going to rent for? And how much money can I make? That's all I care about. I don't care if it's here, Sydney, Melbourne or Timbuktu. As long as the numbers stack, that's all I'm looking at. As an investor, you really need to remove yourself from the emotion. And this sometimes drives my wife up the wall because I've got no emotion when it comes to where we live. As long as it's nice, I don't particularly care. As long as my wife's happy and my kids are happy and comfortable there, then that's the main thing for me. But I've got no emotional attachment to any sort of property, whether it's an investment property or my principal place of residence. So right now, the average yield in Perth is 4.3%. Unless you work with us, then we're still targeting 10%. Compare that to Sydney, 3.1%, Melbourne, 3.3%, and Brisbane, 4%. I still think, although Melbourne is looking attractive from where it is in its own property cycle, which is probably at the start of a recovering market. I still think Melbourne's got another 18 to 24 months before actually flatlines and then starts to correct itself. The state government have absolutely butchered that state with all the taxes that they're implemented there. Yeah, that's all I'll say on that. So some of the things that you need to be aware of when you're reading the newspapers and you're hearing Perth has peaked, what they're really saying is prices have risen, so surely they're going to stop. Let's go back to Sydney again, and the noise on the ground in Sydney from a lot of people that invested and decided to cash out and not invest because they thought it couldn't go any higher and it couldn't go any higher. And look, let's go back again to 2010, 2011, Perth and Sydney, very similar median house price. Right now, very different median house price. Could we catch back up? Who knows? I just know that the fundamentals are there that will still drive price growth in Perth, whether that's from locals and local investors, or whether the East Coast investors might actually go, Perth actually about to go on another run here, because the fundamentals that created this last shift are still there. So property markets are run on fundamentals, not feelings. So ask yourself, can the locals still afford to buy? We've still got the highest wages in the country, 6.8 times income to price ratio. Tick. Is housing undersupplied? Massive tick. Will it continue to be undersupplied? Massive tick. We cannot build enough houses every year. There's different stats out there I'm reading that are saying there's between 50 and 90,000 people a year moving to the state, and we're only building something like 17,000 houses a year. We need to be building 27 to 28,000 a year. We didn't do that last year. We're not going to do this year. We didn't do it the year before that. So every year we're falling into a delta, and we're just getting further and further in the hole. So is population growing? Yes. Green tick. Our yield still strong? Yes. Compared to the rest of the country, they are still very strong. So until they shift, that the market has still got legs in my eyes. What's this mean for you as an investor? I think I've said everything I really need to say, haven't I? Strong population, rental crisis, high wages, low prices, strong yields. I still believe we are 3 to 5 years away from a true peak in this cycle. I believe that the Sydney market, if Alfred Harrison is good at what he says, then Sydney and Melbourne could take a dip and Perth could react differently and continue to go up, just like it did in the GFC, because we've got a really strong economy as well. Yes, everybody says it's a mining town. Yes, mining does add a lot to the GDP of this state, which is good, right? Because when the markets do shit themselves, our mining still goes. People still need them resources. So just to wrap this up, team, actually a short one today, 20 minutes. Perth hasn't peaked. It's not cooling. We're still early. The opportunity is still real. There's still so much demand in terms of affordable housing in this state, and it will get worse. And I still believe the HMO is a massive, massive opportunity for people. There's still not a lot of people doing it here. There's a few people, but nowhere near as much as the rest of the state. However, if you are considering investing in Melbourne, give us a shout. We'd love to work with you. We're going to be doing a mixture of 6, 7 and 9 bedroom properties over there. Rooming houses, should I say. It's going to take me a while to get used to the terminology. And our property management business, our award-winning property management business, will be picked up and it will be set up in Melbourne so that we can offer the same end-to-end service for all of our clients. So if you're keen, reach out. If not, and you're just here for the podcast and listen along to the content, thank you. I appreciate your time as always, and I wish you all the best. Join us again next week on the HMO Property Show.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.